How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is episode 50 to the Asian Session Library. Once again, with my iconic model, with the Asian Session with US dollar versus Japanese yen. Again, we keep it consistent. We haven't changed the pair. Yes, this model can be seen on other majors and other yen crosses, but I'm just here trying to show the community that if you stay consistent to one pair, to one model, you can see results. So let's walk through the steps together. As always, this model is going to be utilizing a dead zone. This dead zone is going to be between 12 p.m. to 8 p.m., just like that. Typically, during this time period, you're going to see consolidation. You're going to see the market ranging back and forth. You're going to see it moving sideways. That is going to be prime for you to catch a volatile move because the market is going from a small range to a large range. Essentially, what this model is looking for is a turtle soup condition. You're looking for price to raid one side of a liquidity pool and revert back to the other side. So let's take a look at this example that formed yesterday, Tuesday, December 10th, 2024. So as you can see, we're going to mark off all our buy side and sell side liquidity pools just prior to 8 p.m. So let's mark that out. So we're going to take all the unbroken swing highs and swing lows. So what I'm using is the 15-minute time frame. And you can see that's buy side here. This is buy side as well. Where else do we have one? We have one here. Now, it's not necessary to mark off every single one, but you will be able to see that the market does draw to certain points for the rating or the draw on liquidity. So we got a handful here, right? This is all buy side here. All this is buy side. All this is relatively equal highs as well. They're pretty close in proximity. Then we have this single sell side liquidity pool down here. So what I'm looking for now, I'm not trying to predict which side the market's going to raid first. I'm just going to simply follow the natural flow of the market. If it's going to run up or if it's going to run down. So if it's going to run down, I'm going to speculate, okay, possible reversal back to buy side. If you do this, that is one scenario. Another scenario, we run up and we run down. Now, when there's multiple layers or levels of liquidity pools, it doesn't matter how many it runs. Once it runs one level, right, one buy side or one sell side, that is when you need to start stalking the entry on the lower time frame. So I go from the 15-minute time frame down to the 1 minute for the entry, and you'll see what it looks like. As always, we like to mark off the opening price of the session. Very crucial because this is going to give us the ideal condition of where we should be buying and selling without any indicators. So the Asian Open is fair value. So you're not paying a premium, you're not paying a discount. So buying or selling around this region isn't too bad. But if we're looking for the pinnacle or the most ideal condition, if we're looking for a long, it better come below Asian Open. If we're looking for a short, it better come above the Asian Open as well. So premium versus discount. So let's play it forward and see what occurs. So we play it forward one candle. Nothing happens. You keep playing it forward until something happens. And there we go. We got a raid on sell side liquidity pool. So this is gone. Now what happens is my eyes, right? All that buy side now becomes the target. So all these levels up here, I'm looking for these levels to be rated. Now, not every single level is going to be rated, but we could predict that more than likely these levels will be the revert or the draw on liquidity after running sell side. Remember, this is all speculation. But because we've been consistent with this model and we understand the flow of the market, we've seen this pattern or we recognize this pattern pretty often, especially with the yen crosses. Not saying it can't be seen in gold, that it can't be seen in other yen crosses, that it can't be seen in the majors, but I prefer to just stick to the yen, US dollar versus Japanese yen. So at this point, I'm going to stalk, right? I'm going to stalk down to the 1 minute time frame. So we go from the 15 down to the 1 minute. And all we're looking for is a fair value gap that runs through a swing high. Now, I don't know how immediate this entry is going to form. That's where your discipline and your consistency, right? And your focus is going to play a major role into being successful with this model or successful with any model that you use. You need to be able to sit here and watch the market because you're looking for that idea. So, right here at this point, you should be stalking that trade idea. We should be looking to buy a long back up to these highs up here. So, let's play it forward. So, until we get that fair value gap, we'll zoom in because I'm blind. I can't really see. So, as soon as we get a fair value gap that runs through a swing high, so right there, see this? Let me double check that's correct because it has to be inside the fair value gap. It can't be at the top and it can't be at the bottom, right? The premium or the discount side of that fair value gap. So this is close to it, but that's not it. So that's not the one. So we're going to keep playing. And you'll see why this is not the one I would prefer. Even if it did produce a good entry, just not the one I'm looking for. So let's just mark this off just to come back to it as a reference. And let's keep playing it forward. And here we go. So our entry now forms right here. Again, if you go back to any of the episodes, you'll see them explaining the exact same way with the exact same sequence. This looks like one here, even though the market starts to trend up from this fair value gap. That's not the one I'm looking for. A lot of people may say, well, why not this one? Why not this fair value gap? Or why not this fair value gap? Well, it's because it's not the one I'm looking for. I'm looking for a very specific one, and it's this one here. It needs to have a swing point that runs through it. Right? The fair value gap, correction, the fair value gap runs through the swing point. This is the one I'm looking for. Right? This swing high is not at the start or the end. It's right in between those lines. So this is where we would go to long right here. Right? That's our institutional entry drill that a lot of people see ICT use. We're simply waiting for price to hit the top of that fair value gap. We're going in long there. And we can play it out. There, the order would be filled. We do go into some drawdown, but we are not worried about the drawdown because if we're managing our risk well, the full stop wouldn't be a problem. It wouldn't keep us up at night or it wouldn't cause us to revenge trade or trigger bad habits into the market. Whatever we're risking, we're comfortable. If it hits the full stop, we're okay with that. We can live with it. It's not going to put us in a too deep hole. We could dig ourselves right back out of that. It's not a problem at all. So if you keep playing it forward, you can see we hit that TP. But going into what? The next trading day. So we didn't finish the trade idea, or we weren't fully profitable until the next true day open, right? Price drops down slightly below midnight opening price, somewhere around here, right? That's midnight opening price. Drops below it real quick, and then it rallies up, gets back up to that Asian open. And if you keep playing it forward, I'm going to 5 minute just to speed it up. Price does stop us out. So at some point, and then the news comes out, and then it spikes up, and it takes out all that buy side that's up there, and probably also rated some sell side that was down here too, below some type of dead zone, or filled in some type of inefficiency. But you can see how these levels are still significant in the marketplace. Look at how it runs right through these levels very fast. Again, we cannot guarantee 100% success rate, but we could guarantee proper risk management. We know how much we can risk. If we have a 10K account, right? Simple numbers, $10,000 in an account, you risk 1% on this trade based on a 1-to-1. This is 15 pips for 15 pips for those that may be asking, or this is the first time you see me explain it. This is 15 pips for 15 pips. So you're risking essentially a dollar for a dollar. And sometimes you could get more than that. If you look at other previous examples, you see sometimes it goes on for more than a 1-to-1. Sometimes we end up getting a 20-to-1, right? And sometimes that's unrealized gains unless you're trailing your stop loss properly or you kept your original stop loss and price never returned to that original stop loss with a hard stop and you held for higher price action. Sometimes this model can coincide and sync up with the higher time frame premise and continue to trend on further. We've seen this numerous times and we're going to continue to expose that to the community. So again, from the top, You can see how we went from running one side of the market. Take a look at this again. We ran out that buy side down here. Bang. We're simply now going to wait for an opportunity on the lower time frame to go long. Some people may want to go down to the 5-3-2. I personally am just showing you how I do it. I'm going on the 1 minute. I know a lot of folks like to ask questions, which isn't wrong. But again, in trading in general, doesn't matter what asset class you trade, you have the autonomy to trade this market any way how. You get to dictate that, not me. I'm just suggesting and showing a way I find success and find consistency in the market. Your entry may look different from mine. You may want to tweak the model a little bit more. Some people don't even start the Asian session at 8 p.m. Some people started at 7 p.m., right? You could do whatever you want. I'm just trying to give you a simple model so you can rinse and repeat. It's a cookie cutter approach for the laziest of traders, for the simplest of traders. I don't like to be stressed out. So the more systematic it can be, the more consistent I can find results, and I can document that, and I can then step in and optimize. Okay, maybe I don't want to trade this model on Monday. Maybe I want to trade it on a Tuesday. Like this Tuesday night was very successful. Might play it forward, and it gave us our TP around there. We're only looking for 15 pips. We're only looking to make $100 or whatever your equity is, whatever that is by 1%. That's what you're looking to make. Now, if you're gonna risk 2%, 3%, that's on your leisure, right? You get the choice to pick how much you want to risk. Again, if you have a small account, you're someone that's new to trading, risk small. You don't have to use standard lots. You don't have to use the largest lot size. You're not here to show off to the trading community. You're here to make money for you and your loved ones and your families, to set yourself up to potentially have side income and then potentially make it a full-time job if it's something that you're looking to do. So again, this is episode 50. We could have been at episode 200 if I would have been posting more consistently when these models occur. And trust and believe, it's not just UJ that this model is forming on. It's forming on gold. It's forming on UCAD. It's forming on GU. It's forming on CADJ, right? Canadian dollar versus Japanese yen. It's forming on GJ. It's forming on Australian dollar versus US dollar. The market might be a little different in how volatile it is depending on the pair because of that Asian session, right? Only certain pairs might be more volatile than others in this section. That's why I like to stick to the yen pairs for this. So hopefully you found this insightful. Peace.